We've passed the first week of February. We're now well into the second week. A lot has transpired in the past few days, and in particular, the market stats for January 2025 are in. I want to share with you the insights that come from those market stats, as well as what is happening in the global markets today. This is a new episode of Building Wealth Brick by Brick with me, Nico James-Bock, a broker and CondoWiz at Royal LePage Signature in downtown Toronto. The TREB average price and Bank of Canada overnight rate. I am sharing a graphic that I share monthly. So let's start with that. The first thing that you'll notice when you look at the graph, if you are following just through the podcast, you can check out the graph on my Instagram account as well as my Facebook business page. At the end of the podcast episode, I will also have a link to those social channels. You can also send me a request and I'll email the graphs and the presentation to you. So the first thing that you'll notice with the TREB average price and Bank of Canada overnight rate is the downward trend in the overnight price, average price as of January. Now, if you look more closely at the graph, you'll notice that during January, the prices do dip. The average price will dip, and that is a trend that took place ever since we had the overnight lending rate increases from the Bank of Canada way back in 2022. So this is not unusual. Even though we're now in a declining interest rate environment, January, December, the first week of the first half of December to the first half of January typically sees a decline in sales volume as well, and that is reflected in a decline in the average price. Remember that the average price is a conglomerate of all housing types. So that includes the condo market. The condo market is seeing a bit of a lag as a result of the high inventory environment that we're in. So many more days of or many more months of inventory in the condo sector, and that's having an effect on the drag in average price. We're going to see this trend line tick upwards as we go into the spring market. Another fact that I want to point out are the events that took place over the past year and a half that contributed to the fluctuation in the average price. Remember that there are 7 factors that determine market value. The cost of ownership is number 1, and that is reflected in part in this graph with the Bank of Canada's overnight lending rate. But there are also other costs involved, and those include shelter costs like mortgage and rent. There was an announcement on December the 15th, 2024, which overhauled the mortgage lending rules, as well as raising the cap to 1,500,000 for those looking to get into the market with less than 20% down. So those are contributing factors, as well as global factors. So we all know what's happening in the U.S. With the new Trump administration. taking power as of the 20th of January. So with the immediate announcement that there will be tariffs on exported and imported goods from Canada, Mexico, and China. We're seeing a lot of uncertainty in the market, and the Bank of Canada is going to look very closely at how this unfolds. The interest rate announcement, the first interest rate announcement that we received was a rate reduction. We're expecting another rate reduction at the next announcement, which will be on March the 12th. But if tariffs are levied against the Canadian government, the Bank of Canada will look very closely at how that will affect inflation, because remember that their priority is to keep inflation at the 2% level, and that's where we're at now. So it remains to be seen if, number one, we will get tariffs, and number two, if there will be other measures taken by the U.S. to that will affect our economy. Looking at the macro stats, the GTA market stats show the average price at $1,040,994, which is up slightly 1.4%. Notice immediately that there are 4.46 months of inventory. Anything below 3 months of inventory, that puts us in seller market territory. Anything between 3 and 4.5, or will be anything between 3 and 4, let's say, will put us in a balanced market. And anything over 4 puts us in buyer market territory. So we are in most markets, most macro markets, in buyer territory, because the months of inventory in all of those markets are showing above 4, more than 4 months of inventory. 37 days on average to sell a property. That goes for all types of housing. And the condo corner shows an average price of $670,675. That's generally what the prices are in the macro market. Obviously, the micro markets will show a different picture. So that's why it's important to, in order to get the overall picture in your specific market, then you need to take a look at the micro stats. I am able to provide those at your request, and that will give you a detailed look at what's happening in your specific market. It may reflect what's happening in the GTA or in some of the other macro markets, or it may be slightly different. As an example, if we go to Toronto's market stats, it shows an average price of slightly just under $1 million, but still up from this time last year, so 2024. And in the condo side, we're seeing 691,039. The Toronto market stats show 4.99 months of inventory, so basically just 5 months of inventory, and that, as I indicated at the beginning, puts us easily into buyer market territory. So the market will be favoring the buyer, and that's because also because that there is such a high level of inventory, particularly in the condo sector. And it's that sector that is having a great effect on the overall numbers, so including average price for all types. Passing to Oakville, which is one of the more expensive markets, the average price is at $1,352,531. Where and looking at the condo So on the condo side, specifically, the average price for a condo is 789,745. But Oakville also has probably the highest number of months of inventory at 5.83. If I were a buyer, or as I'm counseling or advising clients, I would advise them to look in Oakville, where there will be more opportunities. Even though the price point is higher, there will be more opportunities because of the number of months of inventory. Keep in mind that savvy buyers who are actively in the market and taking advice from people like me, are active, and they're actively looking, will be able to capitalize on those opportunities. So if you are interested in making a purchase, I suggest you do so in the next 4 to 6 months. We are in a declining interest rate environment, but that's not going to last forever. So it's really, really important to take these stats to heart, look at them closely in the markets in which you are interested, and you will be able to make your buying decisions accordingly. Keep in mind that there are also many changes to the mortgage rules offered by CMHC and other government agencies, which bodes well for buyers, particularly first-time buyers. We go to Durham region. Durham region is on the opposite sector in terms of months of inventory, 2.90, which is the lowest of all of the regions that I'm highlighting here. So 2.9 months, just under 3 months of inventory puts Durham region in a seller market territory. Interestingly enough, it's also one of the regions that has the lowest average price of just under 900,000. So, as I mentioned, with Oakville and some of the more expensive markets, because of the change in the mortgage rules allowing buyers to get into the market at the 1 million, 1.2, even $1.3 million mark, with lower than 20% down. Where you see opportunities is where you should be directing your attention. Durham region has a lot of different options for buyers, but with 2.90 months of inventory, those options will be eaten up by the savvy buyers who are actively in the market. We go to Mississauga. Mississauga market stats show a similar situation to Toronto and the GTA, with 1,047,000 as the average price. Condo corner is slightly lower at 601,000, so there may be opportunities in Mississauga for particularly first-time buyers getting into the condo market. 4.43 months of inventory is still quite high. So we are still favoring the buyer in most pockets of Mississauga. Mississauga is getting quite popular because of the addition of other transit options. So as we know, transit is a huge motivating factor that helps buyers make their decisions. So anything that's added to the grid will make the area more popular. So the area around Square One, and it goes all the way up to Brampton. That's what the plan is for the LRT. Will open up a whole bunch of other options for the buyers looking in those areas. It also helps sellers, because this is not just a buyer picture. It also helps sellers. With more buyers getting off the fence and taking advantage of the new rules, sellers will see that their properties are staying on the market for fewer days, and they are getting more or less what they are asking for. Pricing needs to be tight in a buyer's market, so most sellers that are paying attention and listening to their advisors are pricing their properties accordingly. The last region that I want to look at is York region. It's also one of the more expensive regions. It has 4.99 months of inventory, so similar to Toronto, exactly the same as Toronto, actually. It has a slightly higher average price at 1,216,000. On the condo side, it's 662,000 as the average price for a condo in York region. Keep in mind when I mention average prices, it means that there are a lot of products that are priced higher and a few that are priced below. So that allows you to arrive at an average price. So keep that in mind. You're not necessarily going to get a condo in York region for 662,000, but you can generally use that as a guide when you're looking for areas in which to concentrate and to put your buying dollars. The Trev forecasts 76,000 home sales in 2025. So that'll be a 12.4% increase over 2024. So we're expecting more sales to occur, primarily because the new mortgage rules will allow more buyers to get into the market. So this projection, this forecast is driven by lower borrowing costs and ample supply. Always keep supply in mind because it's going to take a while for that supply to be absorbed. The average home price is expected to rise to 1,147,000 in 2025. We're talking about the GTA average. So that's a 2.6% increase with stronger growth for single family homes over condos. Condos will remain fairly flat, as I'll mention shortly. January 2025 average home price is $1,040,000, and that's up 1.5% year over year. Months of inventory stands at 4.5, approaching a buyer's market or well into a buyer's market, giving buyers more negotiating power and pressuring sellers on pricing. So sellers, as I mentioned, have to be very, very careful with pricing and not overshoot because that will just turn buyers away. The condo market saw a 13% drop in sales, and as I mentioned, that is because there is a large number of completions, not only in 2024, but there's expected to be a record number of completions in 2025. So that's going to continue. Once these completions are absorbed, however, and that's going to start in the next 6 to 12 months, we'll be dealing with a completely different crisis because now we're dealing with many different fires to put out, and one of those is the high level of condos saturating the market and nobody really taking advantage of them. But we have a lot of people that are coming into the GTA. They'll continue to come in even despite the curb in the student population that's entering the GTA or Ontario. It's not going to matter much. There are still at least 350,000 that will come into the GTA, particularly into the GTA in 2025, and that is easily going to be enough to absorb a lot of the inventory. So the condo shortage will be what we'll be looking at in starting in the end of 2025 and starting in 2026, and prices will rebound fairly quickly. So keep that in mind. Single family home prices are expected to grow faster than condos due to lower supply and higher demand. So detached and semi-detached freehold properties are expected to obviously grow faster than condos. And home price drop and dip in sales is typical in January, as I mentioned at the beginning of this podcast. The threat of US tariffs might alter the landscape, but only if those tariffs materialize. Remember that there are threats for now, and if the Trump administration decides to levy those tariffs on Canadian goods, it'll hurt both economies and drive up inflation. So I don't think that's in anybody's best interest. So we'll see what happens in after the expiration of this 30-day pause. We will take a look now at what the insiders are saying. The stats that I provide are curated by myself and those at Royal LePage Signature. They're taken from Treb's announcement whenever there's a stats announcement by Treb. Treb releases that data, and we quickly curate it. As well, we have contributors exclusively to Royal LePage Signature, one of those being Dr. Sherry Cooper, who's a chief economist at Dominion Lending Centers. She says that the recent acceleration in job growth may not prevent the Bank of Canada from cutting interest rates further this year, because we're also looking at employment. The recent wave of hiring likely won't be enough to placate concerns that a potential Canada-US trade war could plunge the economy into a recession. Still, overnight swap traders eased expectations for a cut at the March 12th meeting to about 60% down from close to 80% previously. So Sherry is saying that they're expecting another 25 basis point cut at the March and June Bank of Canada meetings. The March announcement is on the 12th, Wednesday the 12th. The announcements are always on a Wednesday, followed by an announcement in April, April 16th, and then June 4th. So that's the next round of interest rate announcements. We're expecting 2 cuts at those. I want you to keep in mind that the Bank of Canada has announced that their target rate for the overnight lending rate is about 2% or 2.5%, but not lower. So we're coming close to that with these next 2 cuts. We're standing at 3% right now. Another contributor, a very valued contributor to our analysis of the market stats and our take on what is happening in the market and allowing us to advise our clients is Sean Hildebrand. Sean is the president of Urbanation. Urbanation is a widely respected data company, and they provide a wealth of information exclusively to Royal LePage Signature. Sean is saying that from time to time, buyers should represent a leading growth segment this year to 2025 due to the impact of the new mortgage rules and lower interest rates, as well as the record number of condos available for purchase at prices not seen in years. Move-up buyers and higher income first-time buyers will also help push activity higher in the $1 to $1.5 million segment, as homes can now be purchased with less than 20% down. The condo market will continue to face challenges in 2025 as completions remain at a record high this year. However, opportunistic purchasers, those that are listening to the advice, will take advantage of their improved negotiating power and will be rewarded with stronger market conditions in a couple of years as completions begin to fall dramatically due to the sharp downturn in the pre-sale market. A third contributor, and also highly respected, is Pedro Antunes, who's a chief economist at the Conference Board of Canada. Personally, he says he doesn't think that markets believe that tariffs are going to be applied for any length of time, primarily because of what I said earlier, that it would damage both economies. Because we're not seeing a reaction in equity markets. He says they're not seeing a reaction in the equity markets and stock markets or in the value of our Canadian currency, which if we did see a 25% tariffs, I think our currency, according to Pedro, would fall to the 60-cent mark. So markets really don't believe it. So in his opinion, we are probably not going to get tariffs. And if we do, it won't be for a very long period of time. He goes on to say that the Bank of Canada keeps telling us that the neutral rate may be 250, maybe 275 basis points. We're not quite sure where they're going to land, and so there is not a lot more room to maneuver on the downside. He also says we may get another increase, but it's unlikely that it will be in the next few announcements. If we do get an increase, it'll be later in the year after a rate hold. And finally, there's Benjamin Tall, who is the chief economist at the conference board of at the CIBC. And the Conference Board of Canada. At the end of November, Ben spoke to the real estate management students at Ted Rogers School of Management. I'll have a link to that YouTube video, which is it's quite interesting, quite insightful. Ben always provides quite a bit of detail in his insight. With regards to inflation and interest rates, Benjamin describes inflation as a lagging indicator, comparing it to a brown spot on a banana. By the time it's visible, it's too late. While central banks fight inflation, rising rent and mortgage interest costs make affordability worse. That's why the Bank of Canada is keeping a close eye on the inflation situation and being quite cautious with any further interest rate drops, and will not likely have an interest rate increase for quite some time. Housing crisis and solutions. According to Ben, the current housing crisis stems from poor planning. Advocating for purpose-built rental buildings and multifamily homes with accessory dwelling units to improve affordability is his suggestion. With regard to the U.S. policy impact on Canada, potential Trump policies like tariffs on building materials could raise construction costs in both Canada and the U.S., further inflating housing prices in cities like Toronto and Vancouver. A rising U.S. budget deficit may also increase inflationary pressures globally. And finally, according to Ben, the future outlook, Tal predicts that while interest rates may continue to decline, better planning and construction strategies are needed for sustainable housing growth. So a lot of areas that need to be addressed. We'll see how the picture unfolds. That's it for this episode. As I mentioned before, if you want to receive these stats in an email, just send me a comment. You can also mention in the comments if you agree with what the insiders are saying and what the outlook is in terms of the US tariffs. Do you think that we'll get them? Do you think they'll be long lasting? So let me know in the comments. My name is Nico James-Bock, and you can find all of my contact information in the show notes, and you can reach out to me through the various channels. Ciao, ciao.